Gold and silver markets are currently undergoing a correction from their previous highs, which significantly impacts overall investment strategies. Investors must stay alert to market conditions when making informed decisions. In the financial year 2024, exchange-traded funds, ETFs, have demonstrated robust performance, yielding substantial returns across various funds. This has led to a notable increase in investor interest in these financial instruments. When selecting the best ETFs, important criteria include asset management quality and expense ratios. Opting for well-established ETFs with a solid client base often leads to more favorable investment outcomes. ETFs can be acquired in smaller quantities, making them an appealing choice for investors with limited capital. This feature enables a gradual investment approach through systematic investment plans, SIPs, enhancing portfolio diversity over time. Understanding the distinction between ETFs and stocks is essential. ETFs represent a collection of assets or an index, whereas stocks represent individual shares of a company. This structural difference influences investment strategy. Generally, ETFs have lower expense ratios compared to mutual funds, rendering them a cost-effective investment choice. This affordability can significantly benefit long-term capital growth for investors. For investors, grasping the relationship between assets under management and liquidity is imperative. Generally, a higher asset base correlates with improved liquidity in ETFs, facilitating easier trades. Before making an investment, evaluating both the performance and size of an ETF is essential. Typically, more popular ETFs exhibit better liquidity than their lesser-known counterparts. The liquidity status of an ETF can often be inferred from its spread. Larger spreads typically indicate lower liquidity. Therefore, it is crucial to check the asset size to ensure favorable trading conditions. The allocation percentage of stocks within an ETF, such as Bank Nifty, is a vital determinant of the investment strategy employed by asset management companies. This allocation is closely monitored and regulated by SEBI. ETFs are increasingly popular among smaller investors, allowing them to invest in a variety of assets, including gold and silver, with minimal amounts. This diversification mitigates risks while enhancing potential returns. Investors can establish a SIP in ETFs, enabling them to invest consistently in small increments. This purchasing flexibility simplifies investment management for many. Thanks to SEBI regulations, transparency in investment products has significantly improved, providing investors with accessible information to inform their decisions. These guidelines ensure that fund details are clear and readily available. Bond ETFs offer smaller investors a gateway into larger bond investments, dismantling the barriers that often limit access to high-value opportunities. This accessibility fosters diversification within their investment portfolios. The popularity of ETFs has surged due to their provision for investments through SIPs, which grant flexibility and the ability to invest smaller amounts over time. This accessibility encourages novice investors to embark on their investment journeys. The performance of ETFs is significantly influenced by the trading strategies deployed by fund managers, which can ultimately affect overall returns. Active management plays a crucial role in achieving desired investment outcomes. Investing in gold through ETFs presents a simpler and more efficient method of gaining exposure compared to physical gold. This approach not only reduces costs but also accommodates smaller investment amounts. Building a diversified portfolio through ETFs allows investors to target specific sectors without committing to direct investments. This strategy facilitates better risk management and potential growth opportunities. Investing in a diverse range of ETFs, such as those focused on gold or banking sectors, can significantly enhance overall portfolio diversification. This approach enables investors to capitalize on growth across multiple sectors. Long-term investments spanning diversified sectors, including Nifty and pharmaceuticals, can yield substantial returns. Regular investments in ETFs contribute to the creation of a balanced and profitable portfolio. Ultimately, ETFs provide an effective, cost-efficient investment option characterized by lower fees and flexibility. They are accessible through systematic investment plans, SIPs, promoting gradual wealth accumulation.